All right, let's jump right into this explainer on NextEra Energy. Today, we're mapping out their latest strategic moves and checking in on their financial health for Q1 2026. Now, if you follow the energy sector, you already know NextEra is an absolute giant. But today, we're going to put them under the microscope. We'll be using some pretty rigorous valuation lenses, think Buffett, Lynch, and Graham, to see exactly how they're rewriting their playbook to handle massive shifts in global energy demands. So, here's the staggering question we really have to confront today. What happens when America's largest electric utility decides it wants to double its generation fleet by 2032? That is a massive undertaking. We're going to unpack their financials, a major proposed merger, and the ground-level operational realities to see if their intrinsic value actually matches this huge ambition. To do that, here's our roadmap for today. We'll cover 1. Meet NextEra Energy. 2. Q1 2026 earnings breakdown. 3. The Dominion Energy merger. 4. Renewables and future growth. 5. Balance sheet and credit. And finally, 6. The Wall Street verdict. Let's get right into it. Starting off with Section 1. Meet NextEra Energy, the utility titan. Look, NextEra operates at a scale that very few companies can even dream of matching. If we look at this through a Warren Buffett lens, their footprint across the entire energy value chain creates a massive, almost impenetrable economic moat. They're not just a utility. They're literally the world leader in renewables and battery storage. By expertly navigating tricky supply chain and grid issues, they've managed to become top decile performers across the board: wind, solar, fossil fuels, and nuclear power. Moving on to Section 2, Q1 2026 earnings breakdown, the scorecard. Right out of the gate, we're seeing a seriously strong upward trajectory in their bottom line. Just look at this 10% year-over-year growth in adjusted earnings per share. They jumped from 99 cents in Q1 2025 up to $1.09 in Q1 2026. And actually, they beat the street's consensus estimate by a solid 6 cents. A huge driver for this? Their Energy Resources division, which saw its adjusted EPS absolutely surge from 8 cents to 49 cents year-over-year. That's a huge leap. However, to get the complete picture, we've got to look at the top line as well. Operating revenue came in at $6.7 billion. Now, while that is a very healthy 7.3% increase year-over-year, it did miss Wall Street's $7.43 billion target. From a strict discounted cash flow or DCF valuation standpoint, this slate top-line miss is a good reminder for us to be conservative with our terminal growth rate assumptions, even though their profitability and earnings efficiency are clearly outpacing expectations. All right, Section 3, the Dominion Energy merger, the catalyst. The numbers on this proposed merger are just incredibly accretive. On a standalone basis, NextEra acts kind of like what Peter Lynch would call a stalwart. They target 8% EPS growth and 10% rate-based growth, mostly within a single utility state. But you combine them with Dominion, and suddenly they shift toward a fast grower profile. We're talking projections of 9% plus EPS growth and 11% rate-based expansion and a footprint spread across 4 utility states. Plus, management has explicitly stated this merger should be immediately accretive to adjusted EPS rate at closing. Next up, Section 4, Renewables and Future Growth, the engine. 4.0 gigawatts. That is a massive number. It represents the amount of new renewables and storage origination they just added to their backlog in this first quarter alone. To put that into perspective, management's big plan is to develop somewhere between 36.5 and 46.5 gigawatts of renewable and battery projects from 2024 to 2027. Pulling in 4 gigawatts in a single quarter proves they are executing on that massive backlog at a record-setting pace. But the real story is where that demand is coming from. Out of that 4 gigawatts, 1.3 gigawatts was specifically for battery storage. And even more fascinating? They have a 130-plus gigawatt large load pipeline. You know what's driving that? AI. The artificial intelligence revolution has this insatiable demand for power and data centers, and NextEra is locking in its long-term future cash flows by literally providing the electrical foundation for it. It's a total game changer. Which brings us to Section 5, Balance Sheet and Credit, the safety net. Building out all this infrastructure takes serious cash, so applying Benjamin Graham's defensive investor checklist here is super helpful. And NextEra definitely passes the test for financial condition. They have a debt-to-equity ratio of 1.41, which, by the way, is totally standard for a capital-intensive utility. But the kicker is their incredibly strong corporate liquidity cushion of $10.8 billion. That means even with crazy interest rate volatility, they have a massive margin of safety and plenty of dry powder ready to deploy for expansion. Looking at the credit agencies, NextEra is strictly managing its balance sheet to stay well above downgrade thresholds. For example, they are specifically targeting a greater than 18% funds from operations to debt ratio just to satisfy S&P and maintain their AIM range rating. Protecting those ratings is absolutely crucial. It optimizes their weighted average cost of capital, or WACC, which essentially lets them finance this massive build-out way more efficiently than their competitors can.
Finally, Section 6, the Wall Street verdict, the consensus.
Following all these Q1 updates, we are seeing an overwhelmingly positive response from major institutional analysts. Just look at these upward revisions. UBS bumped their target to $104, HSBC went up to $106, DA Davidson is at $105, and Wells Fargo sits at $102. In fact, out of the analysts tracking the stock right now, an impressive 15 have slapped a buy rating on it, and 2 have gone all in with a strong buy. When you aggregate all of that data, the consensus price target lands at $99.86. Given that the stock has recently been trading around the $88 mark, that represents some really notable upside. Wall Street clearly believes that the company's strong intrinsic value, which is driven by that solid EPS growth, the accretive Dominion merger, and this virtually impenetrable AI infrastructure moat, far outweighs the risks of a slight top-line revenue miss in short-term models. So all of this really boils down to the ultimate question you should take away from this explainer. Can NextEra successfully integrate a mammoth acquisition like Dominion and rapidly scale to meet the exploding energy demands of AI, all while tightly navigating interest rate volatility and those strict credit thresholds? Well, they've got the scale, they've got the liquidity, and they certainly have the vision. But execution over these next few years is what will dictate their ultimate valuation. Keep a very close eye on that 4 gigawatt quarterly build rate. That right there is the pulse of their future. Thanks for diving into the numbers with me today, and we'll see you on the next explainer.